If you've ever entered a trade, felt confident, and then watched price instantly go against you, this video is for you. Before we go any further, do me a favor. Subscribe to the channel because once you understand this, you'll never see charts the same way again. Now listen carefully. Important disclaimer. This content is for informational and educational purposes only and does not constitute financial or legal advice. Most traders believe the market moves because of indicators, news, or random volatility. That's not true. The market moves because of liquidity. Liquidity is fuel. Without it, price cannot move. And here's the uncomfortable truth. Retail traders are the liquidity. Liquidity traps are not accidents, they are designed. Let's start simple. Every time you place a stop loss, you're leaving money on the table, not profit. Money? That money becomes liquidity for larger players. Smart money doesn't chase price. It waits for liquidity to build. Where does liquidity build? Above obvious highs, below obvious lows, around clean support and resistance levels. At trendline breaks, everyone can see. If you can see it on your chart in 5 seconds, millions of other traders can see it too. And that's exactly the problem. A liquidity trap happens when price is pushed into one of these obvious areas, triggers a wave of orders, and then instantly reverses. It feels personal, but it's not. It's mechanical. Let's talk about equal highs and equal lows. When price creates 2 or 3 similar highs, traders start thinking, this level is strong resistance. So what do? They short the resistance. They place stop losses just above it. Breakout traders place buy stops above the highs. Congratulations! Liquidity has been created. Smart money now knows exactly where the orders are. So price gets pushed up, stops get hit. Breakout traders enter long. And right after that, price reverses. Retail traders call it manipulation. Smart money calls it efficiency. Another common trap happens during strong trends. Price moves up aggressively. Pullbacks get bought instantly. Retail traders start feeling safe. They think, this trend will never end. Then price pauses. It consolidates. People start buying late. Stops go below the range. And suddenly, price drops hard. Not because the trend is over, but because liquidity below the range needed to be collected first. Here's the part most people miss. Liquidity traps are emotional traps. They are designed to trigger fear of missing out. Panic selling, overconfidence. Smart money doesn't need indicators, it needs emotions. If you're feeling excited, scared, or desperate on a trade, you're probably standing in a liquidity pool. Let me be clear, liquidity traps do not mean the market is evil. They mean the market is structured. Price must move where orders exist. The mistake retail traders make is thinking, price should respect my level. Price doesn't care about your level. Price cares about liquidity. Now here's where things start to get interesting. Not every breakout is a trap. Not every reversal is manipulation. The key is understanding context, timing, and behavior. And if you want to avoid becoming liquidity, you must stop trading where everyone else is comfortable. Halfway through this video, ask yourself one question. Am I trading what I see? Or am I trading where others will get trapped? Because once you answer that honestly, your entries, stops, and patience will change forever. If this is already making sense, drop a comment. I read them all. When you understand liquidity, the market stops feeling random. Now let's go deeper and talk about how smart money actually hides liquidity traps, because the obvious ones are just the surface. One of the biggest mistakes traders make is assuming liquidity only exists at clean highs and lows. That's only half the picture. Liquidity also builds inside ranges, during low volatility, and right before big expansions. Think about this. When price moves sideways for a long time, traders get bored. They start forcing trades. They scalp. They overtrade. Stops pile up on both sides of the range. This is perfect. Smart money doesn't want movement yet. It wants participation. So price stays quiet longer than expected. Then comes the move. Usually fast, usually violent, and almost always in the direction that hurts the most traders first. Another powerful trap happens around news. Retail traders believe news creates the move. In reality, news often provides the excuse. Liquidity is built before the news. Stops are placed, positions are stacked, biases are formed. Then the news hits. Price spikes one direction, grabs liquidity, and immediately reverses. Retail traders think the market changed its mind. It didn't. The plan was already set. Let's talk about trend lines. Trend lines are one of the most dangerous tools for beginners, not because they don't work, but because they work too well. Everyone draws them the same way. Everyone trades the same break. So what happens? Price respects the trend line until it doesn't. The break looks clean. Volume increases, confidence explodes, and that's when the trap closes. Smart money uses trendline breaks to exit positions, enter at better prices, harvest stops. If a break looks too perfect, pause. Ask yourself, who benefits if this move fails? Another thing nobody likes to hear: stop losses are necessary, but predictable stops are expensive. If your stop is exactly where everyone else's stop is, you're not protecting risk. You're offering liquidity. Smart traders don't eliminate risk. They manage placement. They think in probabilities, not certainties. They don't ask, is this level strong? They ask, where is the pain? Because markets move toward pain before they move toward profit. Here's a mindset shift that changes everything. Instead of asking, where should I enter? Ask, where are traders likely to be wrong? That question puts you on the right side of the chart. Liquidity traps aren't about predicting the future. They're about understanding behavior. Price tells a story. When price accelerates too fast, ask why. When price pauses too long, ask who's waiting. When price breaks a level perfectly, be suspicious. Smart money loves certainty. Retail traders love confirmation. That difference is everything. If you take one thing from this video, let it be this. The market is not designed to reward effort. It is designed to reward understanding. Once you stop chasing moves and start studying where liquidity lives, you stop reacting and start positioning. If this video helped you see the market with clearer eyes, subscribe to the channel and comment below. What was the biggest trap you've fallen into? Because awareness is the first step toward consistency, and consistency is where real traders are made.